Good morning and welcome to Stock Market Today for Friday, June 21st, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email, follow along with this show, as well as receive daily stock ideas for you to consider in your inbox every trading day before the market opens. And before we dig in, just a little bit of a programming note. For the next 2 weeks, I am going to be out of the country on my honeymoon, and my colleague, Nick Webb, will be hosting the show in my absence. So U.S. equities closed higher in Thursday's trading with the S&P 500 reaching a record high close. Energy, industrials, and technology led the move higher, while healthcare, financials, and REITs lagged. All sectors were positive on the day. Treasuries are stronger, sending the 10-year yield below 2% at one point. The dollar came under pressure against the major crosses. Gold finished up 3.6%, and crude had a big rally on geopolitical tensions, up over 5.5%, 5.7% on the day. And we're going to take a look at that a little bit later in the show. S&P futures, as we get to the desk this morning, are down 20 basis points after hitting those highs yesterday. Asian markets were mixed overnight. China leading while Japan lagged. European markets are higher. Treasuries are under pressure and the dollar is stronger versus the yen, but flat on the euro. Gold giving a little back, down 40 basis points. WTI crude is up 30 basis points this morning after that big rally yesterday. So for the S&P 500, we tagged and closed at new all-time highs. Support level gets moved up to the 2850 to 2900 zone, and I've highlighted 2875 here as kind of the middle of that range. With us being at all-time highs, there really isn't price-based resistance at all-time highs. Not yet anyway. I'm sure we'll start to carve some out at some point, but we are not there yet from a purely price-based resistance level just yet. RSI continues to improve. Nice move higher with stocks. That's what we want to see. Now it's what we want to see. Now what we're going to look for is the makings of that shift to bullish ranges. What would that incorporate? That would incorporate the RSI remaining above 40, ideally above 50, as it did back here in the early parts of the year. Ideally holding in the 40 to 50 range would signal to us that momentum is shifting to the upside and would confirm price strength. Good start so far with the RSI getting up near 70 with a strong move higher yesterday, but let's keep an eye on how she trades today. Chaikin money flow is turning bullish. After dipping bearish, we are now ever so slightly to the bullish side of the equation. So that's a nice positive to see with the market moving higher. So RSI moving higher, Chaikin money flow moving higher, stocks moving higher. Now, of course, we just want to see how we react. Futures are down slightly here this morning, giving a little bit back. We're going to check how the RSI reacts on pullbacks. Turning now to our market in a minute. What am I writing about in my note today to Chaikin Analytics clients? Well, new all-time highs for the S&P 500, probably well reported at this point. Geopolitical tensions drive an oil rally, and we'll take a look at that because oil rallied actually from an interesting spot that we called out last week. Small caps continue to underperform large caps, and we continue to like large caps over small caps for equity exposure. Growth fears drive the growth over value theme. That's something we've talked about. We'll take a look at that a little bit later in the show as well. And futures do point to a lower open here today. Now, digging in on the power bars for the major indices. Again, what the power bars tell us is how many stocks in each of these indexes, and we can do it for ETFs as well, have bullish ratings, neutral ratings, or bearish ratings, with the thought being the more heavily skewed to the bullish side, the more likely that index or ETF is to outperform. So the Dow is at 8-4, 2-1 bulls to bears. S&P 500 greater than 2-1 bulls to bears at 142-62. NASDAQ has shown some nice strength of late, greater than 3-1 bulls to bears, 32-10. Small caps are skewed and have been improving from a power bar standpoint. 497 bulls, 327 bears, but they just continue to underperform their large cap peers. So, right, the importance of relative strength. The market's moving higher, but we want to be in the right parts of the market. Right now, that's large over small from a cap perspective. Bonds uptick, sending yields lower. At one point yesterday, yield on the 10-year was under 2%. Energy was the big leader at the sector level, rallying over 2%. with that big rally in crude oil, but power bar ratio skewed in favor of the bears. 11 bearish stocks for 4 bullish stocks. According to the Chaikin Power Bar, large cap stocks and small cap stocks are bullish. Stock of the day today, Connect One Bancorp. CNOB is the ticker symbol there. It has a very bullish Chaikin Power Gauge rating. Due to very strong earnings performance, very strong price volume activity, as well as very positive expert activity. 20 factors in the model give us our very bullish rating. Strong trend, strong industry group, type of name we want to consider. Now, we've had a downtrend that's gone into a consolidation, but let's run through the analysis. Bullish stock outperforming the market. Market and model are in agreement. Dynamic duo in gear. Unfortunately, though, stock is very overbought based on our overbought, oversold indicator. Now, positive money flow is good. Above the rising long-term trend line is good, but we have an overbought market. We have an overbought stock. Why don't we give this one some time? Give it some time to play out. Add it to a bullish watch list. Keep an eye on it. Should the stock become oversold, all else being equal, i.e. it's still bullish or very bullish, it's still outperforming the market with bullish money flow, then it becomes a more compelling entry. But right now, we're going to add it to a bullish watch list. Taking a look now, the sector tracker, the movement of the major sectors over the last 5 days. And you can see energy at the top of the list, especially after that strong move yesterday. Oil's been improving. So what we're going to look for here is, remember, when oil rallied 50% from December to April, energy rallied but remained an underperformer. So we're going to see if energy can start to buck that trend if oil is in fact heading higher. We love seeing technology at the top of the list. It's over 20% of the S&P 500. We want to see tech as leadership. Industrials, remember a couple of days ago we started talking about cyclical strength when we did our relative strength work on Tuesday. Industrials at the top of the list. Communications, round out the top 4. Real estate, healthcare, and discretionary are middle of the road. Utilities, financial staples, and materials are at the bottom 4 performers. All of the major sectors, though, are higher over the last 5 days. So that's an encouraging sign. Now we want to skirt to the relative strength. A little interesting to see utilities not outperforming with that big move lower in yields, but utilities have been strong. A lot of that might have been discounted. Going to keep an eye on that trend, though, because on an absolute basis, the trend looks great. Relative basis, starting to waver just a little bit. Industry in focus today is one that we have been table pounding bulls on, software and services. Power bar ratio for this group, 46 bulls to 14 bears. Over the past 6 months, it's outperformed the S&P 500 by over 12% and still has that very strong ratio, 46 bulls to 14 bears. It's currently ranked number 6 of 21 subsectors, and it's moved up 1 slot over the past week. But what you'll notice is that these stocks, these indicative stocks, Monotype, Leidos, and JCOM, all with very bullish Chaikin Power Gauge ratings, are all very overbought as well. We want to keep an eye on these stocks and look for opportunities when they become oversold, because not only are the stocks oversold, the market's oversold, but the group is, overbought. Strong rallies, they've been overbought. The group is overbought. Look at XSW, the SPDR S&P Software Services ETF. Bullish Chaikin Power Gauge ETF rating. Bullish rating, outperforming the market. Persistently bullish money flow, wavering a little bit, but persistently bullish money flow since the beginning of the year. Nice breakout here above the $95 level, moving towards all-time highs. Problem I have is just look at how overbought it is. I don't want to chase. I don't want to chase overbought stocks in an overbought industry in an overbought market. I think we can be a little bit more tactical, wait for these stocks to come to us. But this is a group that is leadership, has been leadership, and the power bar ratio tells us it's likely to continue to be leadership. So we definitely want to keep it on the radar screen for long ideas, but we want to be disciplined about it. We want to wait and get those stocks when they're oversold. Taking a look at what's trending now. Yesterday's S&P 500 gainers and movers, our movers and shakers. Oracle, earnings report. The company actually returning to growth on the top line. Up by 8% on the day. Now, the theme that you'll notice for a lot of the rest of this, I would argue, is oil related, right? Noble, 6% on that big spike in oil. Holly Frontier, HFC, 5.4% on that rally in oil. Halliburton and Schlumberger, 2 of our poster children for what we have called Chaikin Classic Bears, getting a little bit of a reprieve yesterday. Halliburton up nearly 5%. Schlumberger up 4.75% on that big spike in oil. On the loser side of the board, Carnival Cruise Line's earnings and a plethora of downgrades following their earnings announcement sent that stock lower by over 7.5%. ALK didn't see any real news there. AAL down 3%. Now, if you're an airline, one of your biggest costs is oil, fuel. Now, these are big companies with sophisticated hedging strategies, but the quick knee-jerk reaction higher in oil likely led to some weakness here in AAL. Same could probably be said for the cruise lines. And then add on to that the fact that Carnival had some earnings that disappointed the street. That sends Royal, RCL, down over 3%, and Norwegian, NCLH, down 2.5% on the day. Diving in now, speaking of oil, oil rallied from a key retracement level, and you'll recognize this chart because we were highlighting it last week. WTI crude. Here's that big rally from December to April, and then look, pull back and tested the 61.8 retracement level, where it stabilized, tested it again, and then we get this big run higher. Now, I think it's still early days to figure out if this is likely to continue, but we want to pay attention. And here we have energy. Notice how energy was rolling over with oil. Did not participate to the same degree. Energy during this time was an underperformer relative to the broader market. So a 50% run in oil. And energy was still an underperformer relative to the market. Energy still remains, from a power bar perspective, the weakest group of all the sectors we track. So not getting excited about it yet, but obviously we want to try to catch potential changes as early as possible. And we are watching this because this hold at the retracement level is intriguing to me. Going to keep an eye on it, not doing anything just yet. Growth over value as investors are concerned about growth. And this is an interesting dynamic and theme that we've been talking about. Part of our thesis for the market has been global growth slowing, not contracting, slowing, US and abroad. And in that environment, we argue that investors will pay up for growth. Right? When growth is slowing down, you're more likely to pay up for what is growing, and that is the case here. What we're looking at is the Russell 3000 Growth Index relative to the Russell 3000 Value Index, and it's busting to new all-time highs above the 200-day moving average. RSI never became oversold during this consolidation, so some strength, some momentum behind the trend. And look at what's happening here just to kind of lay it out. The bottom of the chart here, we have copper relative to gold. This is your sign that investors are concerned about global growth, right? Gold has seen more of a safety trade. Copper, a little more cyclical. In an environment where investors expect growth, you would expect copper to be outperforming gold. Well, it's not. It's breaking down. And that's driving this growth trade. Fears of global growth slowing are driving the growth over value trade, or it's one of the drivers in the growth over value trade. It's been a big theme of ours for the past few months, and it's worked out for investors. We continue to see it as an enduring theme. Large over small is another theme that we've been talking about. It's not one that's a little bit counterintuitive. Remember when everybody was concerned about the trade tensions and they were trying to make the case that small caps would be immune to the trade tensions because, you know, their revenue is mostly here? Well, small caps have been underperforming because what investors were forgetting, or people who were making that argument were forgetting, it was the cost side of the equation, right? A lot of the input costs are imported. So rising tariffs could potentially be a drag on margins. What we're looking at here is the IWM relative to the SPY, so small relative to large, and you can see it is completely breaking down below the 200-day moving average. RSI is firmly in bearish ranges, and that while the Russells tried to rally on an absolute basis, continues to underperform large caps. And notice that while the S&P 500 is at all-time highs, small caps are not even close to their highs from last summer. Haven't even threatened them. So we continue to favor large caps over small caps for equity exposure. And then finally, commodities are seeing a lift as the dollar fades. Right? We've been bearish commodities. It's been the right call. And this trend, for the most part, is still bearish, right? Below the declining 200-day moving average. But what's interesting to me is that we've held support at the early 2019 levels. And this most recent leg lower was met with a positive divergence. Notice that when the low was made here in May, the Bloomberg Commodity Index became oversold. Most recent low in June, higher low for the RSI, and now starting to move higher. Something to keep in mind. And that's all happening as the dollar breaks down. Weaker dollar, generally a positive for commodities. So something to keep an eye on going forward. Could be early changes, early stages of a trend change. That's going to wrap it for today. Head over to chaikinanalytics.com/today to sign up for that email. And I look forward to coming back with you again in 2 weeks. As I said, Nick Webb will be filling in for me while I'm away on my honeymoon. I will talk to you then. Have a great weekend, everyone.